You can't be a limited liability company, you can't be a nonprofit corporation, but you can be a for-profit corporation, and it's not a tax designation. It's not a C Corp or an S Corp. You can be either a C or an S. It's a for-profit corporation with all the other attributes of a for-profit corporation with one exception. You are required to create material, positive social, and environmental impact, and we'll talk more about that. I wanted, though, to distinguish what a B Corp is, because there's a lot of confusion. How many of you have heard of B Corp? Okay, so I do want to cover it.
I'm part of the B Corp.
Okay, and Hanson Bridges is actually a B Corp, even though we're actually not a corporation, we're a limited liability partnership. But really what that is there is a group called B Labs that also sponsored this legislation that is a nonprofit and certifies companies, limited liability partnerships, limited liability companies, and so forth, for operating their business in a certain way. Now, the truth is that if you're a B Corp, you probably would be able to do all the things a benefit corp can do, and if you're a benefit corp, you probably would qualify as a B Corp. In other words, the level of what you're doing is similar, but the legal structure surrounding it is very different. There's no legal structure of being a B Corp. All it is a promise by you as an entrepreneur or your company to actually operate in a certain way, and then you are audited to make sure you're doing that, and then you're certified. A benefit corporation, there is no auditing and there is no certification. But if you wanted to be a B Corp in addition to being a benefit corp, you could join B Corp, you could be audited, you could be certified, and we'll talk a little bit more about that, but essentially that gives you an added opportunity to become part of a community. There's an added opportunity if you believe that the certification mark is worth something in terms of both a brand and marketing and giving confidence to consumers, then you might decide to be a B Corp, but it doesn't mean there's a legal structure around it.
Quick question. What does the B stand for? Benefit?
Well, yes, I think that's right. And so one of the things I've lamented about the process is that B Corp sort of started first, and then there was these benefit corporations, right, that are legal structures, actually entities, and there is some confusion. So I would, if it were me, I would like for B Corp to change their name, but I don't control that.
Yeah.
So I want to distinguish, though, between a certification mark and a legal structure, right? I mean, they are the good housekeeping seal of approval, but that doesn't mean that that's a legal structure. So think about it like that. And the reason,
just to help clarify, in the natural foods world, if you are organic, you have to be audited, and you have to meet standards. And I think that's the B Corp analogous. If you want to say you're a farm and you just grow without pesticides, you can make that claim, but you don't have anybody in third party giving you that credit. Is that a fair analogy?
I think that's a good analogy, yeah. There's a couple of other things. That's the branding and certifying part, but let me get into this a little bit more, because I'll cover these questions. You can also, I want to make sure you understand that if you want to become a B Corp and then you later decide you don't want to be, excuse me, a benefit corp, now I'm getting confused. The corporation can then opt out of that, as we'll talk about earlier. So you can go in and out, in the status and out of the status if you find it's not working for you. There's also no impact on other corporations or business entities. That is, it's voluntary. If there's no mandatory telling entities and businesses in this state that they must be a benefit corporation. Why become one? Because there's a lot of conscious consumers out there. You can see a lot of SRI investors are getting involved in the marketplace. Statistically, 60 million Americans are conscious consumers, and there's a 2.7 trillion amount so far that's been measured in terms of responsible investment. So I actually think this 50,000 sustainable business mark nationwide is a little low. What does it do in terms of legal protections for sort of if you have CSR, that is corporate social responsibility values? It gives you the legal authority to consider environmental and social impacts, which in California actually don't have the right to do beyond a certain level. It provides the company with the discretion to prioritize amongst profits and the other kinds of socially responsible impacts it wants to make. It allows for investor and succession planning, and this is the old Ben and Jerry story where you may have heard, Ben Cohen wanted to sell his business and he wanted to exit by allowing bidders to come in and bid for it, but he also wanted to bake the mission in. And if you think about Ben and Jerry's, yeah, I like their ice cream and it's pretty good, but the reason a lot of people went and bought them and distinguished them, right, is because they had a mission, and they were, you know, they were political, and they had a mission, and they did very positive social, environmental, progressive impact. And so there was value in that brand, and when they sold it under corporate law at that time in Vermont, and by the way, Vermont now has benefit corporation law, they were required to sell to the highest bidder, and if they didn't sell to the highest bidder, even if that highest bidder said, here's what we're going to do with the company, we're going to shut the company down. We're going to fire everybody, shut all the plants down, fire the workers, sell off all the assets, and turn it down. But we want to buy it and do that because they're a competitor. They have the right to do that. And if Ben didn't accept that bid, even if the next lowest bid promised to keep the mission, keep everybody employed, keep the product going, et cetera, could do it. Why? Because one shareholder, under corporate law in Vermont, Delaware, and California at the same time, and 19 other minority states, allowed a shareholder to sue for personally, you talked about criminal penalties, this isn't criminal, but you could have personal liability as a director for failing to vote for selling for a maximum shareholder price, even if it was going to completely destroy the company. Now we can debate whether that's a good thing or not a good thing. Some people think that's a good thing. Some people think, I invested my money in a company, I took a risk, I want the maximum amount out. We think that a lot of people in the SRI movement think that they ought to be another choice. You want to be a general purpose corporation that requires that? Great. You have that choice in California still, even after the passage law. But if you want to be a different kind of corporation that is able to bake the mission into the DNA of the company, you have that right now. So as I said, I think I've covered this, but if you're an entrepreneur and it's very important to you to build a company that has a mission and to have some succession planning upon acquisition, this is the kind of firm that can do that for you. So the purpose of a traditional corporation is obviously to engage in any lawful business activity, and it can also define a narrow purpose. It can say, you know, we can do any purpose we want, but we're in the, you know, we're in the food business. Benefit corporation does all of that, but it has the additional purpose of creating general public benefit, which is defined here under the code as a material positive impact on society and the environment. It has to be taken as a whole from the business and operations of the benefit corporation. It adds to, and it could be a limitation on other corporate purposes, so you can focus that specific purpose, and we'll talk a little bit more about that by an optional add-on, which is to add one or more specific public benefit purposes.
So does that imply that a standard corporation can negatively, on a whole, affect society?
I'm not sure I understand. You mean, could you be a benefit corporation and pollute? Or what do you mean, your purpose would be to pollute, or what do you mean?
Well, it says that benefit corporations have to provide a positive material benefit. So does that mean non-benefit corporations can provide negative to society? I think
the reality is, I mean, if you're a shareholder, you're probably going to be unhappy about that because your shareholder value, in theory, ought to go down. On the other hand, there's plenty of companies out there that we know are bad actors, right? Mm-hmm. That are doing things that we may not agree with, but they're able to do that lawfully because their primary goal, other than breaking a specific law, you know, if you, in theory, if you dump pollutants into the water, there's a law to cover that. But as far as the company having an obligation to its shareholders to not do that, there's not an obligation that way internally as to the corporation. And in fact, just the opposite in a way, that the shareholders can't really sue you for making a decision to do necessarily a bad act that increases shareholder value, unless, of course, you know, maybe you've broken the law, a specific law, right? So this creates a better corporate citizen, I would argue.
And then is there a morality outside of the Constitution that is being assessed here?
Your conscience.
Like who's
well,
the
what's the
conscience?
metric?
Yeah, well, we're going to get to that.
Yeah.
I'll get to that. But let's set it up first, because I want you to that you will be assessing your performance against. First of all, the shareholders and the directors will make a decision about what they want to do, and they'll bake it in. Then they'll assess it against a tool. But the first thing I have to decide is, well, what are their purposes going to be? And some of them are listed here. you can have a specific public benefit that includes any of these things, and you would put it in your articles of incorporation. So if you wanted to focus on creating a good product, but you also wanted to do something in any of these categories, and I won't read them, but you can see them up. You can do that, and it's pretty broad, as you can see.
Yeah.
Now, it might be that your product does that. It might be that you create a product that doesn't do one of these things, and then you have as an extra purpose one of these ideas. And now you have the ability to do that. You really didn't have the ability to do that before in California. Instead, everything had to be seen through the eyes of what's called the business judgment rule. In the end, if you did good things for the environment, if you gave money to charity, if you created a better product, if you had better corporate governance, was it going to increase shareholder value? The truth is that most of the time courts won't substitute their judgment for directors. But if it gets too far afield, they will. And if they sell, upon sale, like I told you about Ben & Jerry's, they will. So that's the difference here. And in doing so, the board has to consider the impacts of actions on a variety of groups. Shareholders, yes, but also employees, customers, the community where the either locally or generally, where the benefit corporation exists, the environment, and the short and long-term interests of the benefit corporation, including the benefits that arise from long-term plans. So this is a form now that instead of having to think about each quarter and only thinking about each quarter, this is intended to try to have a long-term impact so that companies aren't thinking about just maximizing value for a particular quarter, but doing it over the long term, which I think will have a great effect, hopefully, on the economy in the long term. That's building companies that are focused on the long term rather than short-term gain. Finally, they do have the opportunity of thinking about if any of the above interests are best served by retaining control rather than selling, as I indicated in the example. And so also the board has to also consider the ability of the benefit corporation to accomplish its general goals and any of these specific goals. Optional considerations that it can consider is the resources, intent, conduct of people seeking to acquire control, any other pertinent factors or interests of any other person or group that the corporation thinks is important in achieving its goals. And typical with a corporation has the right to rely on various professionals, just like any other corporation, in thinking about how to get there. A tip I would have is when you're considering these things as a company that you document them, because your obligation is to think about these things and try to consider them. It doesn't mean that you have to take an action to benefit one or more of the groups. It's just that you consider it. And I kind of analogize to an environmental impact report. When you do an environmental impact report, you have to consider all of the potential stakeholders that are impacted, but it doesn't mean that you have to take or not take a particular action. It's just that you've considered them. In terms of transparency, and this gets to your question about measurement and how you do that, you have to assess on an annual basis the bottom line performance that you've tried to, the triple bottom line performance that you've tried to set forth as a goal. The standard has to be comprehensive. That is, it has to take into account all of the operations of the company, not just the environmental, social impact, but all the other operations of the company. It has to apply the standard consistently from one year to the next and explain the reasons for those inconsistencies. So in other words, this will help from changing one standard from year to year so that you can manipulate your report, if you will, by just changing standards. And I'll talk a bit in a moment about what the standard's about. And as I said earlier, no auditing or certification is required. But if you want to be a B Corp or you want to join some other kind of certification, free trade, fair trade, organic, et cetera, then you can go and seek those additional certifications. So what are these standards? What does that mean? Here's a sample list, and I commend you to go to a website that's been created called benefitcorp.net, and you'll find a whole other series. But you can see the B impact assessment if you're a B Corp or you like that. That's a free assessment tool that will allow you to use it for. There are others that cost some money. If you were in the food business, you might use the Food Alliance standards. So they're
what a board of directors would do would be to search for what standards there are that are independent and that are comprehensive, and look at their industry and see which ones best match the industry. It would be great sitting here to tell you that there was one comprehensive standard that fit every kind of company. And you know, when you look at energy saving among buildings, there seems to be a general agreement in the marketplace that the LEED standard is the one we're going to use. Some people like it, some people don't like it. But the good thing about LEED is everybody has generally agreed that that's a benchmark measurement. We haven't gotten there with sustainable corporations yet. We are at a place where you entrepreneurs are far ahead of the curve, and that consumers are demanding these kind of products. But in terms of reporting and measuring and agreeing on one standard, we're not there yet. There's a lot of standard setting groups out there. In fact, I had one that called me last week to talk about this. They're trying to figure this out, but because companies are in such a broad area of industry, it's pretty hard to do it. So the thought was, let's give the free market a chance, have boards of directors and shareholders decide on what standard they want. Hopefully it's in their best interest to pick one that really is, you know, does the right thing and allows you to comprehensively measure, so that consumers, when they read the report and see it on the website, will say, yeah, I can discern between X company that I don't believe in, or that's trying just to put their own certification mark, right? There's a lot of companies that just make up their own mark and it sounds like something, but we know it doesn't mean anything. As opposed to a benefit corporation that can say, that kind of company, because the law requires them to do certain things, I can trust them, I can trust their product, and I want to put my money where my mouth is. And hopefully that's the thing that's going to create more shareholder value. Just last month, November, Harvard Business School came out with a long-term 15-year study where they have shown, they have measured corporations that have had better corporate governance, better products, treated the environment better, treated their employees better, et cetera, all the kind of reduced risk through better energy savings and all sorts of more sustainable capitalism. They measured the performance, long-term performance for shareholders, increasing shareholder value over time, and they found that consistently, actually, that those companies that tried to be more sustainable did increase shareholder value. And if you're interested in that study, I've actually brought a copy in. Let me dig it out, and then I'll keep talking, and I'll give you the name of it, because you can get it from Harvard Business School, I think. It's so those, I had a lot of clients in the last 5 years used to say, well, yeah, I could put solar on my roof, but that costs a lot of money, and no one's going to move. No one cares about that. They're not going to move into my shopping center because I have solar on my roof. But increasingly they're finding it's true. It's true, right? Now we know that this is important, and it's becoming increasingly important.
Was this in the HBR magazine?
I don't know, but the study is... I've got it somewhere in here. I'll keep going, but hopefully I'll find it. It's from, it might be in Harvard Business Reports, and it just came out in November 2011. Oh, that's because I put it in the wrong place. Okay, so it's called The Impact of a Corporate Culture of Sustainability on Corporate Behavior and Performance. Harvard Business School working paper, November 4th, 2011. It's by Robert, I'll spell the last name, E-C-C-L-E-S. Robert Eccles, and I think the other guy that's pretty famous is George Serafeim, S-E-R-A-F-E-I-M. This is a pretty interesting study, I think, so I commend it to you if you're wondering whether you can say to investors, for instance, hey, I want to do these more positive social and environmental things. You now have a long-term study that actually shows it.
Could you pass it around?
Yeah, sure.
Oh, thank you.
New standards are being developed. As I say, these are just a sample. You can find other standards on benefitcorp.net. And then, so what do you do with this standard? It requires that after taking this assessment tool, that the corporation then draft a written report that expresses the board's opinions on, did it achieve the specific public benefit, if it has a specific public benefit, or the general public benefit that it decided it wanted to create? If not, why not? Did the officers and directors consider, the various impacts that were referenced during the year? If not, why not? And a description of the ways that the corporation may have fell short. It doesn't require that you achieve something specific. What it requires is transparency, and that you tell the shareholders and the public what you were trying to do, and if you did it, and if you didn't, why didn't you do it? So there's no force that's telling the corporation, you got to spend this amount of money, or you've got to make this choice to spend so much money that you put the corporation down the drain because you have a potential positive social and environmental impact. Obviously, the board has got to make sure that the corporation continue, let's say, and that it pay its workers and do the things that it takes to stay in business. So the point is that as you go through the year selling your products and services, that you make a decision, periodically about how you're going to create this positive social and environmental impact, and that you disclose how you did it and whether you achieved it, and if not, why not. I actually talked a little bit about this already, so I won't really go back over it, except to say that in terms of the standard, there's a whole set of things in the code now that talks about what kind of standards you can use. The company can't have a material financial interest in the entity that's created the standard, and the reason for that obviously is you don't want to, if you're a company, you don't want to be allowed, or if you're an industry group, to be allowed to actually feather your own nest, right? You want to make sure it's independent and there's not some financial connection between the entity developing the standard and the entity actually using and performing the standard. The last thing that's currently required is that the report that's given to shareholders and to the public state those that own 5% or more of the benefit corporation's outstanding stock. And frankly, the drafters was one of them, but had a big debate about this. And the thought was that don't want, let's say, a company that might not be a very good company hiding behind being able to create a subsidiary behind its other bad work, but have a subsidiary that it calls a benefit corporation that's not, that's really a smokescreen, if you will. And we're debating that. I'm not sure, in my view, I have a different view, I guess, which I think that most people are trying to do good, and I'm not sure it's really necessary. The standard is taken out of the same standard that public companies use, so that if you're a public company, you're required to disclose those under Section 13D of the Securities Exchange Act, whether who your 5% or more shareholders are. Yeah.
So this point about having an independent standard that doesn't have a credibility, corruptibility connection. I mean, isn't there a connection like we're paying you to certify us? You have an industry group. Let's say all the oil companies have this one company that they go to, and they pay them a ton of money to say you guys are A-OK, and there's no other connection. I mean, is there anything to prevent that? I mean, that seems like a clear bias, a clear financial relationship. Just pay for service.
Yeah, I mean, I think that would be a problem if it truly was a material financial interest. It probably would be a problem. Or if, I wouldn't get to all the details, but if under this code section, if more than a third of the governing bodies of them are commingled, that's a standard for where it wouldn't be independent. If it's not comprehensive in its measurement, that's a standard that makes it non-independent. But the idea is actually to require that there not be kind of this feathering your nest. So yes, I think that sounds like a potential problem to me about whether they could use that standard. And as we'll talk about later, the shareholders have the ability to enforce that the board use an independent standard as opposed to one that seems to use one that maybe they've basically paid off the entity that's creating the standard.
It doesn't even have to rise to that level. I mean, it's simply we want to please our customer, and our customer want us to relax the standards and want all that business. So, then.
Well, they have to report about it, though, and that's the point of the transparency. So in theory, and what I hope will happen is that consumers reward those that are doing better rather than worse by the standard. But it's true, it's the free market, because I don't think, as I said earlier, that we've gotten to the place where we have been able to mandate one standard for every industry. hopefully as these things are developed, but the code section does require that there not be a material financial interest between businesses that are using the standard and the entity. And I think the situation that you raised, I think, sounds pretty problematic to me, because basically the industry is getting together and going and creating an entity that's coming up with a standard that then the industry uses.
Right, it's the
I think
same
that
thing
would-
they do with their regulators.
That would be pretty problematic, I think. I think that'd be pretty problematic.
So when it's
The-
determined that someone did not perform benefits, what happens?
Yeah, we're gonna get there in just one more slide. Just want to make the point that you have to send the benefit report to your shareholders. You have to post it on your website. I mentioned that, but you can exclude confidential proprietary information, including payments to directors and officers and other, employee salary kind of information. If you don't have a website, then you have to provide a free copy to the public if they ask. That's something similar to what nonprofits have to do for their tax returns. Should be a pretty simple process. So to your point, if you don't do it, there's something called a benefit enforcement proceeding that's available for shareholders and directors. It's not for third parties, so an employee can't bring suit, Greenpeace can't bring suit, members of the public can't bring suit, but if the shareholders or the directors find that the corporation isn't using an independent third-party comprehensive standard, not putting out a report, then, or failing to pursue these public benefits, then it can take the company to court, and it can ask the court to please order the company to use the standard and to report on it. There are no monetary damages available for failure to pursue the social environment impact. Unlike a typical corporation, which only has the ability to sue by shareholders for monetary damages for failure to maximize shareholder wealth, shareholders now have two rights. Right number one is to sue if you didn't take care of shareholder values. That is, you can get monetary damages for that on behalf of the company. But also the shareholders now have a right to sue, to say to the company, you didn't use a comprehensive standard, you didn't try, you didn't use reasonable means to pursue your general or specific public benefit, and or you didn't report on it as you were supposed to under the law. And the court could order the company to do another measurement, issue a real report, that kind of thing. But again, no monetary damages. And the reason for that, frankly, is because we thought it went too far. We didn't think anybody would adopt it if directors could be personally liable for that kind of thing.
And how many shares do you need to be able to sue?
One share.
Okay.
There's no requirement that you have 5% or more, 10%
Do you
or
think
more.
that's going
Any
to inflate the price of shares? That people are they're going to want to have a high bar and not, let me, goody two-shoe, go buy one share of every single hypocritical benefit corporation?
Well, I think here's why I think that won't work. It's really expensive to sue a company. You better be really certain that you're really within your legal rights to do it. In that case, if you're not going to get your legal fees. If you are within your rights, the court has the right to award attorney's fees. Just like the court has the right to award attorney's fees to shareholders that sue for breach of shareholder fiduciary duties because wealth wasn't created, if there was some personal reason. And the duty of loyalty, there's all sorts of cases about what that means to be a director and have fiduciary duty to the company and to shareholders. All a long line of cases, very fact specific, about breaching your duty of loyalty, breaching your duty, fiduciary duty to companies. But if it was found, it's possible. I think someone could buy one share and do it, but they're going to be very expensive for them to do so unless there's really a reason. And I think that probably won't happen very much. These suits are very, very unusual, by the way. You might think that it happens all the time, but it actually is very, very unusual for shareholders to sue companies. It's just not, because it's pretty risky. We wanted to create the opportunity, but we also wanted to make sure it was limited and not encourage people and plaintiff trolls, frankly, lawyers, to go out. I'm a lawyer, but I don't want to see plaintiff lawyers go out and say, I can make a quick buck, right, on a company by going and getting my attorney's fees. You better be right.
So no animal chasing in this arena.
Anyone's chasing.
Yeah.
You want to create an opportunity for a marketplace to develop and encourage companies to do this, not discourage companies.
Right.
And there's a balance there. There's a balance there.
Quick question.
Yes, sir.
In this case, the benefit corp, the directors can also sue.
Yep. So let's say you're out,
Is
so,
that
so,
typical of non-benefit corps?
yeah, directors have the right to sue in certain circumstances. They have a fiduciary duty, and if they think the fiduciary duty's been breached, let's say you've got a 5-member board and 4 voted to do X action, and you really think that that's a breach of fiduciary duty, it's destroying the company, destroying you might take the company to court and try to get a ruling about what that means. You might try to get an injunction, or you might try to get a ruling about the fact that could rise to that level if you felt strongly. Now, you might not, because if you didn't vote for it, you wouldn't have personal liability, but you might feel very strongly about it to do that. So, I think I covered all of this.
Can you become benefit corporation by being incrementally better than the second best company in the industry, regardless of the absolute value of the industry? If the industry as a whole is damaging.
Well, to become a benefit corporation, you need actually, if you're a current corporation now, you actually need to convert. You need to change your legal structure. So it's a legal structure, whether you measure up in performance is a slightly different issue. I suppose you could be a non-benefit corporation and be seen to be the most sustainable in your industry as opposed to a benefit corporation that possibly, I guess that could happen. I hope that this will encourage companies to create greater shareholder value and do better by society but I suppose it's possible that in a particular industry that there could be a non-benefit corporation that does better. And why would that be? Maybe you're a benefit corporation, you've got a lousy product. You've just got a product that no one's interested in buying. Okay, so you don't have enough money, right, to go out and do as much positive social, environmental impact as a company that has a more popular product, right? So could it happen? It could happen. It depends on the marketplace, I think.
Well, I'm just wondering, because some people might think, the whole petroleum industry, as opposed to the electric car industry, that the whole petroleum industry is substandard. And, super goody two-shoe Chevron 2.0 could make slightly better Chevron and call themselves a benefit corporation, when in fact they suck ass next to an electric car company.
Yeah. So you raise a really good point. And if you look at most SRI investors, I've got a friend at the Royal Bank of Canada. It's a very, probably it's Canadian, but they're in the United States, and they have one of the biggest social impact funds that people invest in. And they take that fund and they go invest in various places. And BP, for instance, at least until the Gulf thing happened, it was actually right at the top of their list. Why? Because until this happened, it was thought of as a company. Yeah, it's in the petroleum industry, but it does what it was seen in terms of measuring how it took risks to be in its industry a very high performing SRI company.
Yeah.
So I don't think it's necessarily the case that if you're a petroleum producer, you're a bad company, and if you're an electric car producer, you're necessarily a good company, right? You could create this great product and do it with slave labor. You could pollute the environment, making high technology. So and actually your point though, I think goes back to what we were trying to do, which is you want a report, a measurement of the operations as a whole, right? You want to not just know that they create an electric car, but also that they don't use slave labor and child labor out of Asia, that they don't pollute the environment, sort of, in other ways, right? So in order for consumers, I think, and impact investors to really understand the nature of whether this is a really more sustainable capital company, they need to look at the operations as a whole, and that is why the standard requires measuring all of it, as opposed to just the good thing that they're doing. Save the whales, right? Oh, save the whales is great, we're a great company. And not show that they're polluting and having slave labor, et cetera, et cetera.
So they have to report on all those different metrics?
Yeah, they have to report of their operations taken as a whole.
So they have to report on environment and child labor and...
But specific to what they've declared they will do in their articles, correct?
Yeah, well, but yes, but they have to talk about their products and services, even if they're unrelated
to their social environmental impact. It's not just the social environmental impact they report on, they have to report on their operations as a whole. So you can't hide behind,
Okay, so that's, okay.
you can't hide behind, we save the whales, but we're, in producing our products, we're the biggest polluter in the world. You can't hide behind that. You need to disclose that and measure it and have this so that people understand it. And it's really to prevent greenwashing.
And that's across the board as part of the law, regardless of how you actually declare your company.
Yeah, right. And you know, it's a balance. We want to create, as many people as in this room have as many different ideas about how you can create that positive environmental or social impact and create a different kind of, a better kind of product. We don't want to dampen entrepreneurs' ability to think of creative ways and creating better products, you know, better services, doing well by, you know, better corporate governance, etc. But we do want to make sure that things are disclosed and reported on. Like I said, I wish there was one standard and one thing fit all, but I don't think it does. And there's, you know, the old saying about the states being the laboratories of democracy. I think this will be an interesting experiment to see, you know, how companies react to this. We've already had 18 companies on the first day go to Sacramento and convert, with Patagonia probably being the best known. And it was in The Economist last week, the Daily Cost, LA Times. It's getting a lot of good press, but it's interesting because I don't quite know. You know, it's a new form. That's the first new form in 30 years.
How many other states are adopting this?
So now,
Vermont.
seven states, Vermont, the law in 7 states, Vermont, Maryland, Virginia, Hawaii, California, New York on February the 3rd or the 10th, I can't remember which, it will come online. It'll be effective. I'm missing one. I said Virginia. New Jersey, excuse me. It's been introduced and winding its way through the legislature in Pennsylvania, North Carolina, Michigan, Colorado sort of on the way, and then it's being considered in Oregon. And there are plans, though, to go 50 states. The big kahuna will be if we can get it done in Delaware.
Mm-hmm.
Because
right.
Delaware is the state for public companies, for various reasons, which could be a whole talk in of itself.
Just say it again, the ones that already have passed.
Yeah, New Jersey, New York, California, Vermont, Maryland, Hawaii, and Virginia. That's where it's the law, and then it should be, it probably will be the law this year in North Carolina, Michigan, Pennsylvania, and then it's sort of in process in Oregon and Colorado. And there are other plans too, but sort of, you know, they were aiming for some certain kind of states. The big kahuna is, of course, California and New York.
Do you know what the statistic, I mean, you gave the first day. Do you know how many in the last 2 weeks since the law came in California have registered?
Yeah, I don't. One of the failings of all of these Secretary of State's office where you do these filings, in all of the states, by the way, they don't keep track of any of the statistics. I understand that the B-Lab people have, you know, figured out a way to get Maryland to finally say that they would track it. And it basically was that they got a state senator to call the Secretary of State's office and demand that they do that. You know, politics. We've been talking to the California Secretary of State, who does not track this kind of things. They have no idea how many reliability companies there are, how many California, they don't know any of that stuff. And it's hard being in state government these days. There's not a lot of resources to do that. On the other hand, there is a discussion being had, and we hope that they will start tracking it. We only know anecdotally. I've had a couple of new companies just in the last week. In fact, I have a call with a university tomorrow, private university that's going to, this is a nonprofit university that's thinking about converting. There's been a lot of interest in it.
Converting from a nonprofit to a C Corp or an
Yeah.
S Corp.
It would probably be a C Corp, so, and that's a very complicated procedure, because if you're a tax-exempt entity, you've got to, your assets are, you're basically going to have to buy the assets from the nonprofit, because your assets are dedicated to charitable purposes. You just can't convert.
Right.
So let me just finish up by talking a little bit about how you become a benefit corporation. Most corporations, if you're one kind of, first of all, you can incorporate. That's the easy way to do it. But if you're a current corporation, you need 2/3 vote of the shareholders. If you're another kind of entity, like a limited liability company, you also need 2/3 vote of the controlling interests. That's a little different than California law, which is typically majority. 50 plus 1, right? And the reason for that is because we really wanted to make sure that there was a serious alignment amongst the shareholders in doing something like this. So we created a 2/3 vote. You have to either prepare your articles or amend the articles that you currently have and add the statement, this corporation is a benefit corporation. Boom, that does it. Pretty simple, amending your articles to say that. You can also, if you want, the specific purposes I stated, you can include one or more of those specific purposes if you like. I also think that I'm recommending to people that they add the statement that they're creating a material positive impact on society, because that's right from the statute. And I like to make sure that companies I work with don't have to call a lawyer every time they want to know what they're supposed to do. So they can just look at their own articles, and there it is, as opposed to having to go and find the corporation's code and call me up on the phone and pay me to do it. You also then file these papers with the Secretary of State's office. A couple of other things. Your stock certificates have to say that the entity is a benefit corporation, and that's to put the world on notice that this is a different kind of company. It's a disclosure idea. There's no requirement, but I think, and I'm recommending to clients that they change their bylaws. The bylaws are the kind of the rules of the road for how corporations operate, because there are some differences here, right? I just enumerated a lot of the requirements and things that one has to do, and I think it's a good idea for the shareholders and the directors to kind of agree and put some rules of the road in the bylaws as to what they're going to do, what they're trying to focus on, and how they will get there. Because obviously what I've shown you today is rather general in nature. Then the real work comes, right? When the board gets together and says, how are we going to improve health? How are we going to create a better product? And so if the shareholders, and they don't have to, but if the shareholders and the board want to agree to do that, they can do that. And you can either create a policy, just like any other policy, or you can put some rules of the road about that into the bylaws.
But there are no state guidelines.
There are no specific state guidelines because, again, we wanted to make sure that corporations had the right to create what they wanted to do. There was great resistance. There was talk about it. In fact, the opponents said, well, what you're going to do is to tell companies what to do. We don't like that. That was a lot of misinformation put out there, and I think the legislature would have been highly resistant to the government telling companies how they should do it. In a sense, eventually, like with the LEED certification program, there has been agreement on certain of those things, and maybe that will have, maybe there will be a range in terms of what you have to meet in terms of standards going forward, but we're not there yet. If you're a current corporation or a current other entity, and you're amongst the third that don't vote to become a benefit corporation, you do have dissenters' rights in this state. Let me explain what that is. Some states have dissenters' rights and some don't. California has dissenters' rights for entities where they merge or acquired or where they convert, and the particular shareholder doesn't agree that that's a good thing. They have the right to dissent, and they have the right to have their particular shares bought out at fair market value. We can argue about whether that's a good thing or not, but that is the law in California, and we didn't think that we would get this, we would not have gotten this passed without that opportunity to have dissenters' rights. It's also the reason, by the way, why we're mindful that there's going to be a lot of startups that are interested in this and probably don't have as much money to do this kind of thing if there's a lot of dissenters. And so that's one reason why we created a higher shareholder approval threshold, because we really wanted to make sure there was true alignment. And so obviously the earlier in your history of being a company you do this, the better off you are in terms of getting alignment as you grow. It's harder to get alignment amongst hundreds of shareholders or thousands of shareholders.
But the costs are not out of pocket, other than the creating of the alignment is the cost.
Well, it is out of pocket if, for instance, and it's typically the law with any kind of organization, if it merges or is acquired and the dissenting shareholders don't agree,
Right.
they can be bought out for the fair market value of their shares at the time of the vote.
Right, but I'm saying that for a company to do this on its face, there's no fee involved.
Oh no! If let's say
And you don't
everybody
have to
agrees.
show up in person in Sacramento.
No.
Yeah, right.
Let's say everybody agrees. No one wants to be bought out.
The fee would be, if you're incorporating, $100 to incorporate, plus there's some other filing fees. Or if you're converting from another kind of entity into this, it's a $150 filing fee. You may or may not need some legal help.
If you're not converting, if you're already a corporation and you're not making any changes,
The only thing you're doing is
submitting a change in your article.
$100.
So
Excuse me, yeah, it's $100 to amend your articles.
Is
And
it
there's
$100 to amend your article now?
It's $100 to amend your articles.
Okay.
And probably, unless you walk it to the Secretary of State's office, which is unusual, but can be done, we did that on the 3rd, you might use a corporate filing service, which is another fee. But other than that, that's
You
the
can't
only.
just send it in with $100? Well,
6 weeks.
yeah.
You can do it, but yeah, you can do that. You can mail it in, but how did you know it was 6 weeks?
Because I just filed the corporation.
Oh, right.
They
okay.
told me it'd be 6 weeks, we paid the fee.
It'll be 6 weeks before they even stamp it.
Right, right.
It's not 6 weeks till you get it back. When we walked it in, they said it'll be 2 weeks till you get it back. If you want to pay a filing service, you can expedite it. It's hundreds of dollars to do that. They can expedite it in 48 hours, but basically, if you mail it in, they won't even pick it up for 6 weeks. Then you probably, so I'm telling people if they mail in, 2 months at least. And you gotta do that assessment tool, then you gotta create a report. Some assessment tools are free, so if you want to use the free tools, they're out there. Again, on that website I commended you to. And then it's staff time, right? Now, your staff ought to be thinking about what their strategic goals are anyway, periodically. And so it doesn't seem to me that this is really, there's no requirement that it be a 50-page report or what have you. So as a board of directors, you're periodically thinking about your strategic goals and objectives are and whether you've met them. And so having staff keep track of that, essentially you're doing what you're already doing in a corporation.
So are there benefits to it financially?
Well, I think there will be. I think that based on some of the information I've given you already, that consumers are going to reward you, hopefully by having a better kind of company. It's a branding exercise. It's a PR opportunity. It protects you upon acquisition. So we're in the initial phase. Will consumers reward companies that are benefit corporations? I hope so, and I think that will happen. But we are in an experimental phase because it's never been done before. This is the movement, if you will. This is the SRI movement coming of age and using legal protections to help those entrepreneurs and impact investors and consumers who are interested in it. A couple of things I would say is we haven't been able to get a tax benefit for it yet. That's because we're in a recession and the legislature it was very scared we were trying to get a beneficial tax impact, right? Because they want you to pay your taxes and they don't have any money. The city of Philadelphia is giving benefit corporations, B-Corps and benefit corporations, a tax break. And the city of San Francisco, David Chu, the president of the Board of Supervisors, has stated his intention to introduce legislation that would give priority in city contracting to benefit corporations. That would be an extra number of points, if you will. So if you had two corporations exactly the same products and services and costs and so forth, but one's a benefit corporation, one isn't, the benefit corporation would get some extra points. City contracting, several billion a year, so there's potential reward in that. I think if we ever get out of this non-recession, whatever we're calling it, I think and the public wants to reward companies doing this, I think that there might be some opportunity, but we're not there yet. It's just not the right atmosphere.
Is there any value to considering this in the LLC realm, or is it just not an issue with respect to the public in LLCs, and therefore it's a non-issue?
Yeah, well, you can already do it in an LLC. The corporate structure didn't allow it in a corporation,
Got it.
but a limited liability company actually, you can do that. And I've actually advised, in my citizen advocate hat, I love this. This is a great thing. When my lawyer hat and representing a particular client, it's very important for you and your lawyer to discuss whether it works for you and whether it's necessary. And there's all sorts of reasons to be limited liability companies. There's all sorts of great reasons in terms of how you manage your capital. It also has limited liability. The answer is you don't have to in a limited liability company. On the other hand, venture capitalists in the capital markets don't like limited liability companies. They invest in C Corps, period. So this was an opportunity. What's that?
They don't do S Corps.
No, because you can't have preferred shares. And so no institutional investor is going to invest in as an S Corp. What they're going to do is make you change your status from S Corp. Management is going to have common shares, and the venture capitalists or other institutional investors are going to have preferred shares. And that destroys the S Corp status. You have to, really S Corps are for small, the S is for small business corporation, right? Mom and pop, or a few people, they're all treated equally and invest. But if the minute you
It
start
actually
getting,
stands for simple, though, right?
yeah,
Yes.
but I call it small.
Yeah.
Because that's really sort of what it is, really simple. Yeah. But the answer is you don't have to do it. I've actually already told a client in analyzing their situation that I didn't think it was their best option, because that limited liability structure is very important for them for tax reasons and some other reasons, how they take capital in and they manage it differently. So they're not going to do it. You know, but they don't need to do it. They figured out another way to say their message in a way that gives them the benefits of the benefit corporation without changing their tax status, essentially. Sir?
Two questions. One, just a point of clarification. So within the legal structure, we're a C corporation. We become a benefit corporation. Within the state understanding, that's a C benefit corporation, or is that how
Your
it
has nothing to do with your tax structure.
It doesn't
So
change the C corporation status at all?
It doesn't change it at all. The only way you actually have to elect to not be a C corp. You would actually have to file a paper with the IRS and with the state in order to be an S corp. So your default is always C, and whether you're a benefit corp or you're not a benefit corp, you're going to be a C corp unless you're some kind of other entity, and that's not. Yeah. Your second question
Was with regard to acquisition. If you're a benefit corporation and company looking to acquire you is not, where does that?
Yeah, so you raise a good point. You're going to end my talk for me, so thank you very much. So I told you that at least a 2/3 vote of shareholders to adopt or terminate at the top. So if acquisition of the shares is going to essentially be by a non-benefit corporation, it will require a 2/3 vote if it's going to terminate essentially the status, the benefit nature of it. So if another benefit corporation acquires, it's different, but if it's a non-benefit corporation, it could, depending on the circumstance, destroy it. So yes, you'd have that 2/3 in or out. So the idea is to make it a little bit more difficult to get in, to make sure there's really mission alignment, and also make it a little bit harder to get out once you're in.
What's been the feeling of your clients about becoming benefit corporations? Has there been a lot of excitement, a lot of energy?
Yeah, a lot, as I mentioned. You know, we had 18 corporations on the first day go to the Secretary of State's office to walk it in. It's been in the Daily Cost. It was in the Economist last week, page 57. LA Times.
The upper management
CSR.
of the people. I don't know.
Oh, you mean in actual companies?
Yeah.
Well, in the companies that know about it and have decided, there's a great deal of excitement. You mean a sort of for-profit public companies, or
Just your clients?
Oh, I think people are excited about it. Yeah, tomorrow night we have 35 companies coming to our forum in San Francisco to listen to hear just what you've heard today. We had one of my co-chairs of my legal work group, another law firm, had about 50 people in December come and hear about it. I'm going to be speaking at Haas about it. Haas has invited me to come speak. Social Venture Network has invited me to come and speak. All of the major legal education groups, PLI, Rudder Group, and so forth, are planning discussions about it to teach lawyers. So I think it's been actually quite a lot of discussion about it, and it's just sort of starting. You know, it's not on everybody's mind, but it's starting to get a lot of publicity. So let me just finish one other thing. I told you this, but some of you might say, well, can you do this without a lawyer? And for those of you that are a corporation already and you don't need to make many changes other than amending your articles, you have one line to add. If that's all you want to do, you can do it. You can mail it, and you don't need me to do it for you. I would say, and there's lots of providers out there for startups. The way I think about this is if you're a single shareholder and you have your own company and you're the only one in it, you can always use a Nova Press to start a company or do something like that. But once you have two shareholders or you start getting other investors involved, you really, really probably do need a lawyer to assist you in thinking about the right kind of structure. So I don't want to dissuade anybody. I just want to be realistic about it. And I can tell you that I've had for getting started and just doing it on the cheap until you maybe get some investment, it might be a great way to do it. Once that starts happening, you're probably going to need a good accountant and a lawyer. And I've seen, unfortunately, mistakes made where we had to later on spend some money, unfortunately, because the thing wasn't set up right. So I think there's a balance to be had there. Lastly, here's some other resources I mentioned. You can see this benefitcorp.net. It has a lot of resources on it if you're interested in hearing more about it. Or you can call me. I'm happy to talk to you about it. And the Secretary of State's office has the forums if you can find them. I mean, it takes a little bit of investigation. It's not laid out so great, and then you have to kind of figure out if it's the right form. And maybe you can do that, or maybe you need a lawyer to help you. And if you have any questions, my cards are here. Feel free to call me or send me an email if you think of follow-up, or if you have any questions now, I'm certainly happy to answer them, sir.
If you're, and of course this is also new, I don't know how this is a great question right now, but
Every question is a great question when you don't know the answer.
if potential buyers or potential investors are assessing two somewhat similar competitive companies, you'd like them to, ideally you'd like them to favor a beneficial corp over the non-beneficial.
Yep.
But do you see as we move forward any political stigmatizing of the beneficial corp, like environmentalists get stigmatized instead of companies integrating consideration for the environment into their own decision making? They kind of polarize and say those are the good guys and we're the good guys, they're the bad guys kind of thing. Do you see that kind of thing evolving with the beneficial corp concept?
I think there are a lot of reactionary people in society, and there are people who philosophically object to this idea, including some of my brethren on the State Bar Corporations Committee who oppose the bill and think that the free market ought not reign. We ought to have it the way it is, and we ought not introduce another element. And also, by the way, those lawyers, they felt, I think, that this adds another. Lawyers are trained to reduce risk, and if there's something new, that sounds risky. There are also elements of society that I think might try to twist it for their own purposes. You see that all the time in politics. I mean, you see how people do things, and there have been some minor writings about this idea that have been opposed to it, but the great number of them have seen it as a rise of socially responsible investment culture, which is a small amount in society, but it's rising. So the answer is yes, I think there will be negative reaction to it, but I think so far what I've seen is a very positive reaction, as shown by all the states that are rushing to do this. This is a jobs creator. This is why the legislature did this bill. Ultimately, in their minds, it was to make California a center for a new 21st economy focused on what I'll call sustainable capitalism, because it's going to go somewhere. Right now, the Bay Area is a pretty big leader in it, but people were demanding that the legislature do it, or they were threatened to go out of state, and some people would have.
What was the reason for those demands from the corporations themselves?
Well, the reasons were, as I said, because you can't do succession planning in the way we talked about. There's a risk of minority shareholders suing you if you do too much of a mission. And so those ideas, and also because they wanted the legal structure to bake in this idea of what their mission was. And they saw that, in addition to being able to do something good, a way to create their own shareholder value. Those entrepreneurs that want to create it in a different kind of way. And so the idea was, interestingly enough, just as an anecdote, California was a hard state to deal with. I mean, it had the political issues in the state not being based on merit. The Republicans and the Democrats fight over everything in the state. And so because a Democrat introduced it, the Republicans were against it. In North Carolina, unlike this state, a Republican introduced it. And it's been a bipartisan, it's a Republican state, right, generally. It's a slightly purple, but pretty, the legislature's controlled by the Republicans and nothing's going by. They saw it as free market. And in most states, including New Jersey, seen as a free market opportunity. Give the people in that state another choice. And what they do with it or how they decide to do it is their business. And so Republicans in most states view it that way. And I think Democrats too. But in this state, so sometimes you get into a situation where you know, it's politics based, it has nothing to do with the merits, and I saw that over and over and over again in committee hearings. Luckily, we prevailed, and it did win some bipartisan support, but, you know, change is hard. Change is very, very hard, and so to answer both your questions, yeah, I think it's going to be, I think it's going to be a battle. It is a battle. It's a battle to try to get businesses, and people are out in the streets because of it. You know?
Well, it certainly jacks the conversation, because it moves beyond the place of that rigidity that you started with, that says a corporation has one purpose and one purpose only. We now at least have a place that says legally corporations can have a different one, and I think that's interesting.
A multiple purpose. And I wanted to say also, this is not actually a new concept. Actually, before the 80s, before these laws, you know, there was certain case law that came out of Delaware. Corporations were actually viewed as more communal. I mean, yes, of course they were supposed to give shareholder value, but they were seen as you know, being able to. I mean, there's a long history about sort of how corporations came into being and who gave them that right to start and what they were supposed to do. You know, originally from the king and what the king allowed them to do. It was only in the 80s that these notions of, you know, short-term shareholder profit maximization came into being, and I would argue that our society has had some trouble because of it. The other issue I wanted to raise is it's California that's in the minority. Actually, the multi-stakeholder model has already been enforced for other reasons in 31 other states. Now, for a different reason, but so it's, and it's had, some people have raised the issue, well, now everybody's going to sue, because you don't know where your loyalties lie. In these other states, 31 states, in 30 years, there's 5 cases. And they're pretty mild about what they do. There's just, to your point about suing, there's not a lot of lawsuits out there. People replace boards if they don't like them. It's harder in a public company, but there's certain ways to do things. And so I think we're not going to see a lot of litigation on it. I actually don't. That's not what worries me. I think what worries me is that it'll be manipulated, that the press will manipulate it, or there'll be some kind of campaign because there's some people that don't like the idea. Or that we won't get the word out. And that's what my co-chairs and other people in the community are doing, is going out and speaking so that people can learn about this and take advantage if they want.